At hand, and this is session number 5 on the second day. The topic at hand is taxation of cross border activities, current tax treaty issues. In the chair today, we have Ms. Rachel Saw. She's the head of IBFD Asia Pacific Knowledge Group and of the chair of IFA Malaysia. Ms. Rachel Saw, ladies and gentlemen.
Thank you, everyone. I'm so glad you cut your coffee break short. We are running behind schedule, so we have the unfortunate job of trying to catch up on time. I have a full panel. They are busting to share all their stuff with you. So I am going to go for the shortest intro ever, right? We are looking at things that affect see, I've lost it now. Tax treaties. I just want to say this when it comes to tax treaties is that, it's really great that we have so many things going on, new fancy initiatives, bright lights, all that loud music. But at the end of the day, what has remained constant and what is still in use and will still be in use and still there are your tax treaties. They are not going away. They are staying put where they are, and they will still be in use. So a little bit of attention left to them would be nice, I think. Let's not get caught up by all the glitz. And I have this great panel here today. And I'm just going to really shortcut this. So we have Ola, Paramchan, Seema, Bijal, Dhruv, and Walter there. Walter to handle the panel session. Ola will start off with her presentation, which will cover PPT, beneficial ownership, fees for technical services, something that we really like here in Asia, and also something that has come up quite a lot recently, MFN. So Ola will set the scene, and then we will deep dive into the panel session where the panelists will share their feedback and views with you. So thank you very much.
Thank you, Rachel, for your very quick introduction. Welcome, everyone. Good morning. It's a great pleasure being here. And as Rachel said, the topic of my presentation is the current tax treaty issues, global developments. Well, so there are many issues related to interpretation and application of tax treaties. I chose 3 fundamental issues that in interpretation and application of tax treaties, which are entitlement to treaty benefits, certainty in tax treaty application, and expansion of the taxing rights of source states. So when talking about the entitlement to treaty benefits, which is really one of the key concept or key issue regarding the application of tax treaties, I will focus on the principal purpose test, PPT, and the beneficial ownership. I will approach the issue of the certainty in tax treaty application from the point of view of the application of the most favored nation clause, MFNs, and I will discuss the expansion of taxing rights in case of fees for technical services. So starting with the first topic, which is entitlement to treaty benefits, and as I said, I will discuss 2 aspects here. The first one is the principal purpose test, and the second one is the beneficial ownership test. And now I'm moving to the PPT. So when looking at the PPT in the context of the recent developments, I would like to say 3 things. The first one, it is a new measure, a relatively new measure. It was introduced into the treaty models only in 2017. But although this is a new measure, it is already broadly incorporated in the tax treaty network. The reason for this broad incorporation is because of the PPT entered the treaty network through the mechanism of the MLI. And since it was part of the minimum standard, it was actually PPT was by far the most chosen option by contracting states. So in the current landscape of tax treaties, we have a very broad interpretation in implementation of PPTs in the tax treaties. And what comes with it, there is definitely a need for at least a relatively uniform application and interpretation of those provisions and some clarity regarding their interpretation. So this is my point number 1, which means really a broad incorporation of PPTs in tax treaties, which takes me to the point number 2. Well, yes, there is a need for a uniform interpretation, but there are issues regarding the very broad wording of the provision itself. And because of this broad wording, the provision is really prone to very divergent interpretations. So on my next slides, I will come back to this point. So building on the point of the possibility or a real chance that there will be very different interpretations of the PPTs under the tax treaties, we definitely have a clear risk that there will be disputes between the tax authorities and taxpayers, but also dispute between tax authorities of different countries. So coming back to the point of the broad wording of the provision and the challenges that it brings with regarding the uniformity of the interpretation by different states. As I said, the PPT is formulated broadly and it allows tax authorities to deny treaty benefits in the situation where one of the principal purposes of a transaction, of an arrangement, is to obtain a tax benefit. But such tax benefit still will be granted in the situation when granting a tax benefit is in accordance with the object and the purpose of the tax treaty. So as you can hear, we have a set of very broad wording, open-ended, quite abstract concepts, including in the measure, and that brings some interpretive challenges. Just to name a few, the very typical one related to GAR interpretation is how to assess the intention of the taxpayer. How to assess whether indeed it was a principal purpose test or one of the principal purposes of the transaction to obtain a treaty benefit, and also how to weigh the treaty benefit purpose against other purposes of a particular transaction of an arrangement. So this is one of the difficulties. Another difficulty is, of course, as I said, the measure contains this very important curve out that says that treaty benefits still should be granted in the situation if granting such a benefit is in line with the object and purpose of the treaty. So how are we supposed to define or find out, where are we supposed to find out the object and the purpose of the treaties? Here we also, again, we can really expect very different interpretations by different countries, also for the reason that there are already GARs, domestic GARs implemented in the jurisdictions of many, many countries, and we see from practice that this type of tests are interpreted really in a very divergent way. So, still on the topic of the broad wording of the measure and the risk regarding the sort of lack of consistent interpretation, I would like to illustrate it with the example of the recent case, Alta Energy case. This is a case that was decided by the Supreme Court of Canada, where the key issue, the key question of the court was whether in the situation that there's a clear tax benefit and where the transaction clearly involves the use of a shell company, so a company without any substance, whether still in such a situation, are we dealing with the abuse of law, yes or not? So just to start with the decision of the court says no, there is no treaty abuse, so the treaty benefits can be granted in this particular transaction. Treaty benefits being, in this case, a double non-taxation of a corporate restructuring. So the court says, yes, no, there is no treaty abuse. There are several reasons given by the court for this, but one particular one is relevant here for this discussion, and this is the interpretation that the court gave to the term object and purpose of the treaty. And its reasoning, the court assumed the object and purpose of the treaty based on intention, as assumed by the court, the intention of the treaty negotiators. So the court assumed that the treaty negotiators, they do know the tax system of the country, of the other treaty countries, so they knew the system of the tax system of the Luxembourg, and knowing the interaction of the domestic law with Luxembourg in this particular situation, it would lead indeed to a double no taxation. So since the negotiators didn't include any measures preventing the situation, it means that in this case, obtaining a treaty benefit is indeed in accordance with object and purpose of the treaty, which to some can seem to be quite a far-reaching conclusion. It's also interesting to mention that there was a dissenting judgment, and in dissenting judgment, it was said that in the situation that the treaty benefits, granting treaty benefits to shell companies cannot be considered to be in line with object and purpose of the treaty. So this example gives us a sort of flavor of what sort of interpretive challenges we will be facing when tax administrations and courts will be interpreting PPT. Considering how similar set of patterns can be interpreted by other jurisdictions. So on the topic of entitlement to treaty benefits, I discussed the PPT, and now I'm moving to the beneficial ownership. Well, beneficial ownership is another key concept when defining entitlement to the treaty benefits. And unlike the PPT, beneficial ownership has been with us already for very, very many years. So it was introduced into the treaty model in 1977. Implemented broadly in tax treaty network. However, although the fact that we are dealing for so many years with the concept, with the application of the concept, it still definitely lacks the clarity and brings a lot of interpretive issues. There are many reasons why this is the case. Just to mention one is the fact that the treaties don't give us the definition of the beneficial ownership concept. So the only reference point that we have is the guidance that is included in the OECD commentaries. And this guidance tends to be changing over the years, where basically the scope of the concept is significantly changing. So this creates certain practical issues. Well, the first one, uncertainty for taxpayers. Of course, because if the beneficial ownership status is denied, then the treaty benefits are also denied. So there's a lot of uncertainty on the side of the taxpayers, whether in a particular situation there would be found to be a beneficial ownership and if the treaty benefits can be granted. Another issue that is coming to play is the coexistence of the beneficial ownership concept and the PPT. So since PPT entered into the network of so many countries, this coexistence has to be considered, and here there are also no uniform views. So some claim that beneficial ownership concepts becomes sort of obsolete because all the anti-avoidance issues now can be addressed under the PPT rules. Other claim that, well, actually there is a different role also that the beneficial ownership concept plays. So they basically somehow in one way or another should coexist, but we don't know exactly how it will play out in practice. And the third point, third practical implication is the question, what are the consequences in this situation when after taxpayer is deemed not to be beneficial owner? So there's also not really a clear practice. There was recently a case, the Planet case, decided by a French court, and it was the first time that the French court decided that in the situation when that the treaty benefits to the real benefit with the treaty should be applied with the state where the real beneficial owner is the resident. So basically, after denying the treaty benefits with the recipient of the income that is considered not to be the beneficial owner, still we should look for the residence place of the beneficial owner. So as we can see, there is a number of issues and uncertainties as regards the concept of beneficial ownership. Moving now to the next topic, which is certainty in tax treaty application. I will discuss this from the perspective of the application and interpretations of the MFN clauses. Well, there has been a lot of discussions, of course, in India in particular recently on the interpretation of those MFN clauses. The reason for this is that MFN clause can significantly modify the treaty upon an event happening in the future. So it has, when activated, the MFN clause has a significant impact on the treaty provision. However, although they're very common, there is no common wording or standard for the MFN provisions in the tax treaties, which result in the difficulties in the interpretation of those clauses. That creates certain instances of uncertainty. For example, a key issue in the application of the MFN clause is identification whether a trigger for activation of the clause took place. So there's lots of uncertainties regarding whether that already took place. Another area of uncertainty is defining whether once activated, whether the treaty modification happens automatically or whether certain future actions are required. So, for example, issuing a notification. And here, of course, that echoes with the recent decision of the India Supreme Court in the Nestle case, which later also will be discussed by the panel. And now moving to the another key issue in the application of tax treaties, which is the expansion of the source state taxing rights in case of taxation of technical fees for technical services, FTS. It goes without much explanations that for the developing countries, the issue of taxation of fees for technical services is one of the key aspects. Why? Simply because the developing countries are in most cases importers of technical services. For that reason, they want to secure their taxing rights also in the situation when the service provider doesn't have a physical presence in the source country and doesn't create a permanent establishment. Tax treaties provide various solutions for this issue. So there are some provisions that allow source taxation of FTEs. There are different provisions that regulate this. Most of them are modeled on the UN model provision, Article 12A, but there are also other options, for example, expanding the scope of Article 12. So there is a number of treaties that have a specific provision allowing source taxation of FTEs. The question remains here whether the current treaty network provides sufficiently for the opportunity for the source states to tax FTS at source. So with this question in mind, based on IBFD data, we did a survey of the tax treaties that were concluded in the last 12 years, so treaties concluded since 2011. So we examined 741 treaties, looking for in how many treaties there are actual specific provisions allowing for taxation of fees for technical services at source. So we identified that in this network of 740 treaties, there are around 210 treaties that in one form or another allow for source taxation of FTEs. Now here the question is, how many of those treaties, how many of those 210 treaties will have one form or another of the source taxation of FTE are actual treaties between developed and developing countries? And why is it an important question? This important question because, as I said, the developing countries are the main importers of technical services, which are usually provided by the developed countries. So this treaty relationship is really is relevant for this examination. So looking at those 210 treaties that have a specific provision on FTEs, we found out that it's only 68 of treaties, so really a small number of treaties that actually are concluded between developed and developing countries. So the remaining number are treaties concluded between two developing countries, which is nice, but doesn't really address the real issue. So we can conclude based on the survey that actually the issue of expanding source taxing rights for developing countries for FTEs, that this objective hasn't been met. Thank you very much.
Thank you, Ola, for setting the stage and really for laying the basis for our panel discussion. With that, I'd like to hand over to Walter, who will take us into the specific topics that we have outlined today. Thank you.
Thank you, Rachel. Thank you, Ola, for your clearing. In the meanwhile, I have the pleasure to host Michael Leonard in our panel. So our panel enriched at the very last moment.
An
and
unexpected pleasure.
Welcome. You are welcome. And please feel free to intervene whenever you feel it's the case. Ola, you guided us through the steepy path of some of the most controversial and difficult to interpret clauses encompassed in tax treaties. And we indeed need to consider, as Rachel said at the very beginning, the fact that a substantial part of the economic actors, despite the rush, to go towards Pillar 1 and Pillar 2 approaches, will still have to apply treaties on a bilateral way or, when possible, multilateral. It is with this very clear idea in mind that our panel, which is composed by all distinguished professionals with their feet very well grounded in the economic and legal reality, that we will deepen the discussion and we will take inspiration from your presentation. First, in the never-ending clash for the attribution of taxing rights between the resident state and the source state, being conscious of the continuing expansion of the taxing rights of the source state, Padam will give us his view on technical fees and automated digital service fees clauses elaborated at the UN level. Bijal will then proceed by guiding us through the state-of-the-art of the Indian positions with reference to treaty benefits and interplay with the principal purpose test. And Seema, after, will dive into the beneficial owner and LOB clauses, summarizing the importance of these legal technicalities, assuring that treaty benefits are granted to the right person. And moreover, she will recall our attention on the balance, which we believe it's always necessary between preventing of tax avoidance and the legal certainty. In conclusion, Dhruv, with his eloquent speech, will recall our attention to the treaty interpretation concepts and the development they had in relevant jurisprudence. So I kindly ask Padam to start with his presentation on technical fees and digital services.
Morning to you all. Ola has laid down the background of new taxing rights that source countries are trying to implement. And this gives rise to an interesting background itself as to what are we looking at in terms of taxing rights today? What are the new nexus norms being developed today? Because we are having some traditional norms of taxation, maybe an asset in a particular jurisdiction, an activity in a particular jurisdiction, service being performed in a particular jurisdiction, the person being present in a particular jurisdiction. These are all the known factors for having a taxing right. We are now moving into new nexus norms. And that's an interesting development for us to pause, look back and ask this question, what are these norms being developed and what are they referring to? For example, when you talk about a market being a right of tax being available to a market because the users are there, because the sales are happening there, because there is a base erosion there in that particular jurisdiction, because there is data from that jurisdiction concerned. So interesting norms are being developed today in terms of saying that the source jurisdiction has a right of taxing. And when you try and balance these traditional nexus norms with the current norms that are being developed, one does notice that we were long ago giving a good amount of emphasis on the supply side factors, not looking at the demand side factors. But now they are saying that the demand side factors are also very important. The market is very important. The users are very important. The consumers are very important. And therefore, the demand side factors should now start having a role. And when you look at this demand side factors, we are having this taxation now being increasingly spread over to a many number of transactions concerned, where we're not looking at the income component of a transaction, we're looking at the transaction value itself. We're trying to tax on the gross value of a transaction. We're therefore getting certain characterizations of indirect tax also coming into direct tax to say, hey, that's a convenient measure of taxation, and therefore there shall be taxation on a gross basis, taxation without any threshold being available to an individual concerned, therefore technically being called upon to pay tax even in case of a loss. And because that's the situation concerned of loss also suffering taxes, they're trying to find out carve-outs now to say that if you would like to make a statement to the source jurisdiction, that I would like to be governed by the normal taxation because I have an accounting records being available with me. And there are certain critical rules being laid out in the article relating to fees for technical services, as also automated digital services, that the 30% of effective profits are going to be taxation based for the source jurisdiction concerned. One does get an interesting emphasis now that accounting also is playing an increasing role, not only in relation to this aspect of technical services, but also in relation to the pillar 2 transaction. Therefore, accounting is getting primary importance, consolidation. That becomes a very interesting emphasis about accounting having an increasing role to play in terms of taxation. So therefore, along with this aspect of new sources of taxation now, we also have to be mindful of the fact that today, increasingly, what were traditionally transacted as goods are becoming services. So getting more and more into services. Therefore, we're having a situation where some sort of a blurring is happening between the transactions earlier accomplished by the dealing in goods are now having those same transactions being accomplished in the manner of rendering a service. Therefore, the question is that when you're having an increasingly blurring, they're getting narrower and narrower. Should the tax regime be different? Because interestingly, one finds that we are laying a significant amount of emphasis on services segment, not that much of emphasis on the goods segment. Goods, we are looking at traditional permanent establishment, please pay tax there. No permanent establishment, don't pay tax there. Services, we're looking at it entirely differently. Fees for technical services, we're trying to develop a new regime. Automated digital services, we're trying to develop a new regime. Royalty transactions, software transactions from 23 September onwards, the proposal is that even software transactions should be taxed as a royalty. And therefore, they're getting increasing situations where the economy or the economic sense of the transaction is moving differently. Tax is moving in a different direction where they're trying to carve out special rule for services to say that we'd like to have a special rule for services, and where there are goods that were originally transacted as commodities but are becoming now services, digital services, they're also being grouped under the umbrella of services for being taxed independently. And therefore, this gives rise to some sort of an overlap. And that's an interesting statement to say that if there is a transaction, let us say in software, will it be royalty? If it is royalty, under what limb will it be royalty? Will it be technical services at all? Because I'm making a payment for some sort of a know-how involved. If you look into the income tax definition, they talk about services in relation to the above. So services can also be a part of royalty. Would transaction and software be a part of automated digital services because you have content creation being there, we have cloud services being there. Therefore, we have a significant area of overlap coming about where they're trying to make a statement that a particular transaction may get covered between or by more than one limbs concern, and that gives rise to another complexity of its own between the various limbs concerned, which is the most appropriate for the purpose of levying a tax. But coming back to the aspect of this uh, technical services transaction, an interesting statement, therefore, is we have borrowed from the Indian philosophy technically. What we had from 1976 onwards, applying, now getting a global reaction to that to say it's worthwhile implementing that. And we are having a statement where it says technical services shall be managerial, technical, or consulting. They shall be these three items concerned. It's only in the commentary, not in the main body of the definition, we find a reference to say that for it to be qualifying as fees for technical services, there has to be a specialized knowledge, specialized exercise of skills concerned for it to be called as technical services. The definition, although does not refer to this attribute of specialized knowledge, it only talks about managerial, technical, or consulting. The commentary says no, it has to be a brain work involved. It has to be specialized knowledge involved for it to be qualifying as technical services. Therefore, we possibly have to rely upon the commentary for the purpose of understanding. Although in plain terms, the definition may say something else technically, but the commentary is saying routine services shall not be technical services. Again, we're finding the carve out from the definition in the commentary, not necessarily by the explicit words of the definition concerned. This is going to be by itself some sort of a concern as to how are you going to interpret that definition concern. And along with that will be the difficulties in terms of the reimbursements. Today, the commentary that is there, proposed para 76 onwards, talks about reimbursement. Will they be called as technical services or will they not be called as technical services, giving a right to the source jurisdiction to tax? Para 76 says they should be having a right to tax. Even reimbursement shall be a part of technical services Although in the subsequent paragraph, they're trying to carve out to say, in particular situations, reimbursement shall not be called as a fees for technical services. But that again is a very interesting development in terms of understanding the taxing rights at the source jurisdiction of technical services and what happens to reimbursement that are associated with the rendering of certain services concerned. And associated along with this is the aspect of automated digital services concerned, where they're saying that this is a case where I'm delivering services through the digital mechanism, through the internet, through electronic mode, where human involvement is minimal. That means I'm able to scale up services without incremental cost being available to me. I don't have a bespoke interaction with the person concerned. I don't therefore have human involvement from my side. Although from the recipient side, there may be a human involvement, but from my side, there's no human involvement involved. And therefore, from the point of view of the person rendering services concerned, you're looking at the human involvement, minimal human involvement. That will be a classification of automated digital services concerned. And they're giving certain examples now, online gaming, they're saying digital content services, online teaching services, cloud services. These are classic examples of automated digital services. And therefore, it will be a case where these are certain routine services being there, equipment is in place, the systems are in place, delivery happens through the system concerned, and is received by a person in terms of a service concerned. These are transactions of automated digital services. But the difficulty in these situations concerned is that, let's take the example of an advertising. When an advertisement payment is happening, the person who's making a payment may be from one country, the person to whom the advertisement is targeted and the user may be a different country concerned. And therefore, to say that the payer jurisdiction will have a right of taxing, will have some element of conflict to be resolved to say that, hey, there is a payer in one country, user in another country, how do you balance that could be a matter of some concern. So apart from the overlap issues concerned, they could also have a situation where multiple jurisdictions could lay claims on it on the same transaction concerned. One on the basis of payment originating from a particular jurisdiction, the other saying the person who consumed the services in my jurisdiction. And the last aspect I'll deal with, though not necessarily a part of it, because to understand the scope of what's happening now, look at the transaction in software now. An interesting statement that's coming about in the proposed commentary in Article 12 now, saying that we would like to have a separate limb for royalty for software transaction. Person who's using software, they're using the word, reviewing the word computer software, saying person who's transacting in software and who's buying a copy of the software for the purpose of using it shall be classified as royalty. And that shall be a situation where the statement is that because we're trying to carve out a separate limb in the royalty definition, we are giving them a proposition that you could have different rates of withholding tax for different limbs of royalty. It's a new development that's happening, an interesting development. We have to be mindful of development that take place tomorrow. That different limbs of royalty could have different rates of taxation. And therefore, we may have a situation 3% taxation in relation to royalty and little more taxation in relation to others. But that could be an interesting situation that the justification is that letting out of property gives rise to royalty. Letting out of equipment gives rise to royalty. Therefore, letting out of software also should give rise to royalty income itself. And that again is a very interesting situation, though not addressing the very classical examples that if book were to be normal income, why software should be taxed differently? That controversy remains. But then these are developments that we have to be mindful of, looking at the new taxing rights and looking at the source jurisdiction saying, I would like to have an increasing right of taxing you. And that could be the way we go about looking at the future.
Thank you for your presentation. You touched upon the inclusion of the copy of software and the potential overlap with the Article 12b. Do you have a kind of solution in mind to let's say, deal with these articles and the potential overlap?
I will talk about services aspect. What could be the potential overlap? Let's just imagine situations concerned. How can services be taxed? Can they be taxed as business income? The answer is yes. Can they be taxed as technical services? The answer is yes. Can services be taxed as royalty incomes? I made a statement, experience and services possibly can be taxed. Can services be taxed as automated digital services? The answer is yes. Can services be taxed as independent personal services? The answer is yes. Can services be taxed as dependent personal services? The answer is yes. Can services be taxed as director's fees and all? The answer is yes. Now, you therefore obviously have a situation where this is going to be an overlap as to what is going to override what. And interestingly, therefore, I'm not going to all the controversies concerned. I'll confine myself to the recent developments of technical services and automated digital services. Look at the way the language is, very interesting. They say, subject to the provisions of Article 8. That means Article 8 will prevail over all of these concerns. It will prevail over technical services, it will prevail over automated digital services. Shipping incomes, whatever be the nature of services, Article 8 will prevail. The supremacy of Article 8, therefore, is maintained. But notwithstanding anything contained in Article 14, notwithstanding anything contained, that means technical services will override independent personal services. Automated digital services will override the Article IPS. Therefore, they're trying to draw a balance now between, therefore, IPS and ADS. ADS will prevail. Between IPS and the technical services will prevail. Therefore, the hierarchy is laid down now. The technical services and automated digital services will have a hierarchy, better hierarchy than this. But what's interesting, therefore, to note also is, in technical services, personal services are being exempted. We don't have such exemption available to us in automated digital services. We don't have such exemption available to us in royalty aspect. Therefore, it's important for us to look at the wordings very carefully and look at the hierarchy now, that supremacy for Article 8 is there, thereafter supremacy for royalty, thereafter supremacy for ADS, then only supremacy for IPS. That's the way we have to have a link concern from out of the language available under the statute.
Thank you, Padam. Before giving the floor to the other panelists, Michael would like to give some thoughts on the relevant articles and on services. So
Yeah,
please, Michael.
what I thought would be useful is just to give you a little update on development in the UN and the recent meeting of the UN Tax Committee on some of the services issues. Of course, it's well known that inclusion of software and the definition of royalties will be in the new model. Rasmi is actually the expert on that. Another thing that's happening is that there's a proposal in the subcommittee before the committee to delete the deemed PE for collection of insurance premiums or insuring risks in your state, and instead to have a gross taxation of the premiums under Article 7. So that's still to be decided, but that's the proposal of the subcommittee before the committee, and the subcommittee is actually most of the committee. Also, additional guidance on Article 14. There's still differences about whether Article 14 applies only to individuals or also covers legal persons. And another thing which is being looked at in the digitalised and globalised economy subcommittee is looking at compressing it, bringing together Articles 5B, 12A and 14 in a single services article. And one of the issues there is, should 12B be included? And I think at the subcommittee level, they think that 12B should be kept separate, which would mean that the net approach in 12B would not be taken in respect of the other articles. But there's quite a discussion in the subcommittee on that matter, and there'll be quite a discussion in the committee on that. And the other thing which I'll mention is relevant to really all these is there's quite an advanced work within UN of having a fast track instrument so that like-minded countries, stressing that, can try to more quickly implement changes in the UN model, such as 12A, such as 12B, if they agree on those, a bit like the multilateral instrument. So in probably, I think about 2 weeks, the report of the last session, the committee will be available in a draft unedited form. So have a look at that, and you'll see some of that's within the committee at the moment.
Thank you. I will give now the floor to Bijal, which will have a presentation on the principal purpose test and the tax benefits and the interplay with the treaties.
Thank you so much, Walter, and good afternoon to everyone. So very quickly, to give you an overview of treaty abuse cases over this last 12 months. Most of you are aware that majority of the foreign direct investment into India has come in via jurisdictions such as Mauritius and Singapore, and therefore not really surprising that the more than a dozen tax rulings which we have on anti-abuse are vis-a-vis entities which are set up in Mauritius and Singapore. Very interestingly, though the revenue authorities, with respect to applying tax treaty benefits for sale of Indian securities resulting in capital gains, in spite of the article not really having a provision with respect to beneficial ownership, did really, try to strike down the treaty benefits to essentially say that the structure lacked substance. They were not really the beneficial owners of the income, etc. However, the judiciary, of course, has provided the treaty benefits so long as the tax treaty, the TRC, is essentially in place. This leads us to an interesting question as to how would the provisions really change once we do have the principal purpose test really in practice really being implemented, and what would really be the challenges on that. Very interestingly, as Ola mentioned, when you're looking at treaty abuse, if at all the purpose and object of the treaty is specifically to allow for treaty benefits, then to that extent, the applicability of the MLI on PPT does need to be diluted. If we just race back 20 years ago, looking at the Azadi Bachao Andolan case, one of the core principles which the Supreme Court really enunciated upon was the fact that the object and purpose of the treaty in itself was to allow foreign investments from Mauritius into India. And even if at all it led to a situation of double non-taxation, you do need to honor the treaty commitments. So that's an interesting principle. And the question which would really come in, as I mentioned, is when you have a principal purpose test and when you're looking at beneficial ownership, which really overrides the other? Seema will, of course, speak in the next discussion with respect to beneficial ownership. But a very quick overview of what the principal purpose test really is. It can lead essentially to the disallowance of treaty benefits if it can be established that obtaining the tax benefit in itself was one of the principal purposes of the concerned arrangement. And this really takes us to the question as to what really is principal purpose and how do you really address and define the same. As you would all be aware that we so far do not have any judicial precedents in India as to how does a principal purpose really be defined, especially in the context where the general anti-abuse provisions have a context of a main purpose test and not really a principal purpose. The notable Indian tax treaties which have notified the MLI are essentially Singapore, France, Japan, Netherlands, and the ones which have specifically not notified the MLI so far are Mauritius, US, Germany, and China. These are the important and countries through which a lot of investment has come into India. And the clauses or the articles which would be most relevant in these situations would essentially be capital gains, fees for technical services, royalties, as well as dividend and interest. Let us look at an example as to how would you really apply the principal purpose test in a structure like this. You do have a BVI entity which has pooled in investments from various investors around the world. The main purpose of the BVI entity is essentially to make investments, one of the jurisdictions principally being in India. What the BVI entity really does, it sets up a Singapore entity to make these investments into India. Under the India-Singapore Treaty, as you would be aware, there is a limitation of benefits article which limits the benefits of the capital gains tax exemption if at all the Singapore entity has not incurred a $200,000 expense in a period of 2 consecutive years prior to the same. Now, this particular Singapore company has interestingly actually incurred this particular expense, maybe as a consultancy service to its group entities. And to that extent, if this was really to be looked at in the era prior to MLI, similar to the Delhi ruling in the case of Golden State, wherein on the holding of a tax residency certificate and in principle going by the letter of law of the limitation of benefits article, the judiciary has allowed for treaty benefits. How do we look at this particular situation in the MLI construct when you have a principal purpose essentially only being to avail treaty benefits. And that is something which leads us to the question that when you're looking at LOB as well as the principal purpose test, which would override the other? Important to note, as per jurisprudence, to the extent that the limitation of benefits article is essentially anyways considering it an abuse, you don't really need to look at the PPT provisions. However, the question really arises that what could have the Singapore entity done to really strengthen its position? Would employees and office, etc., be more relevant? And it would really showcase that the principal purpose was really to move to a jurisdiction where you could actually employ professionals to provide consultancy as to whether to invest, whether not to invest, etc. So this leads to an interesting question, and to that extent, the concept of LOB versus the PPT, somewhere it could be very clearly argued as to which really prevails over the other. And this takes us to our next example, wherein you have a situation where a French company has two subsidiaries, one in Lithuania, the other in Russia. Because of the geopolitical situation in Russia, the entities or the subsidiaries below the Russian entity, the group CFO believes that he really needs to restructure so that you do not really have sanctions with respect to activities being carried out in the other country. Very interestingly, one of the jurisdictions which are sitting directly under Russia is an Indian company, an extremely profit generating entity, and continuously really reaping dividends to really pay off to its shareholders. When you're looking at this group restructuring, is it the duty of the CFO to choose a structure which gives you the worst tax? In this particular structure, let us assume that most of the subsidiaries below Russia are folded into France, and only the Indian entity is moved into Lithuania because they want to take the benefits of the 5% dividend withholding tax, which the treaty with India really offers. So this is an interesting proposition, and here very clear from the commentaries that it is not the duty of the taxpayer to choose the worst structure which is available vis-a-vis the taxes. However, having commercial activity really conducted always is an important parameter. And to that extent, when you're looking at the applicability of the MLI, you do need to apply it to that particular context. Concluding thoughts, and this is very interesting when you're really looking at just a mere definition of what is principle or what is main. Principle, by the mere definition of the term, means number one. Unless it's a tiebreaker, you cannot have two people sitting in a number one. So the question really arises: can you say one of the, one of the principal purposes, or it should just be a principal purpose? The second important point to really note is that when you're looking at general anti-abuse provisions, you do have safeguards on when it could really be applied, vis-a-vis a monetary limit, vis-a-vis the procedure the revenue authorities do need to apply. With respect to the MLI, the PPT provision, there are no safeguards so far really provided in the domestic law. And this leads us to an interesting question, that is this a reverse burden of proof wherein the taxpayer would essentially need to prove that I did not set up this vehicle just for the avoidance of tax. And to conclude, the principle of what is reasonable has always been a matter of debate in the Indian judiciary. And what would be the principles of reasonableness when you're applying the principles of natural justice when in the context and contours around the principal purpose test? With this, I would like to conclude. And if any questions, Walter, very happy.
Yes, you touched this point earlier in your presentation, but considering you have a couple of more minutes, I think you can expand the reasoning this. And I'm very curious to know your point, because as tax planners, we are always, asked to maximize the effect of a structuring. And the principal purpose test is so controversial, and it's so kind of entering into subjective parameters when you make a judgment, that you may, in order to be conservative, try to choose the structure which is not exactly the best one. And how is your approach? How do you approach this kind of choice?
Absolutely. One is all of us need our jobs. So we do need to ensure that we have a tax structure which is viable for, an MNC. I think what is most important, or what my advice to a client would really be, and given the fact that, Walter, as you mentioned, that the principal purpose test is absolutely subjective. When you're really looking at any planning structure, very important to actually build the commercial rationale as to why you have really chosen a particular jurisdiction. And to that extent, having having employees, a place of business, as well as a very strong commercial objective. You can't really be having employees who are in an investment company who really know nothing about investments. That doesn't really beat a commercial rationale. But to the extent that you're really able to build a particular business activity, to that extent, it really can, it could be essentially said that the principal purpose was to really move to a jurisdiction where I could engage and employ professionals required for my business. And yes, though an ancillary purpose would be a tax benefit, but my main reason or main rationale where I went there was to really set up a business and really have that really skill set. So I think it is very, very important that we do have a commercial rationale which is so strong, while it is being set up, that that can be really taken as the principal purpose rather than just a tax benefit.
Thank you, Bijal. Just an observation on this. The arguments of locating a company in a certain jurisdiction because you can hire people of a certain level of focused on your business. I think nowadays with the digital nomads concept is it's an argument which is losing a bit of grip. So again, it's controversial, very difficult to take a decision on this, but it is what it is. So we need to deal with that kind of uncertainty. But thank you very much for your answer. I leave the floor to Seema now, which will enlighten us on beneficial owner and LOB.
Everyone, good afternoon. Just in the interest of time, I'm curtailing the presentation. I'd actually started with why treaty abuse and the traditional sources of limitation on benefits. But I think one very important concept for everyone to remember is that whenever treaty abuse is being looked at, it's very important to understand what are the different perspectives that an officer could have and under what provision of the treaty is he really going after you. And so, in that context, beneficial ownership, limitation on benefits, and PPT, though interrelated, are different concepts. It's important to understand that beneficial ownership is really it's an intensity of your ownership attributes on income. Under beneficial ownership, the officer can question whether you really own the income, which is why you would always see it in treaties in your interest, dividend, and royalties clauses. It doesn't extend to your capital gains clause. And all that you really need to test in this is that do I have the right to dispose the income? The question of did I set up this entity in order to be able to get this exemption is not relevant. Somebody has assessed you under the beneficial ownership clause. As opposed to this, when you go to the limitation on benefits clause, the limitation on benefits clause has traditionally been introduced to establish your connection with the residence jurisdiction in order to be able to identify if you have sufficient nexus with the jurisdiction. And then that brings us to the PPT clause, which is really the all subsuming clause. It says that any kind of treaty abuse is not really permissible. And which, so now in academic circles, there is one debate that in the era of PP, is beneficial ownership and LOB really? And if policymakers, it is understood that, a treaty is a political compromise, and if in spite of having PPT, if there is a beneficial ownership clause, if there is a particular limitation on benefits in the treaty, should that not be respected? We could have just deleted it when we introduced PPT. We could have just done away with all of it and said we want to test everything under PPT. So, for example, if you look at the India-Singapore treaty, the fact that we left the $200,000 threshold, should that not be respected? Does it not reflect the intent of the policy make? Why did we just leave it? So these are interesting questions. Whenever you're being tested, one is to be very clear that under beneficial ownership, all that you need to establish that you had the right to dispose the income as you pleased. There is no need for you to have ownership of the asset. In a very interesting ruling, Delhi High Court had in the ruling of Fujitsu, there was an American company rendering management services, and the tax and in order to render those management services, the American company was availing services a lot of group companies. The American company actually went to the extent of saying that for the advertising services, it's just a back to back from Japan. We are not doing any value add when we are recharging back to the Indian subsidiary. But the High Court said that that is not relevant. What is relevant is when the fee has come into your hands, are you entitled to dispose it in the manner you deem? And according to me, that was a very good ruling. Indian courts have a very rich history, very, very wise jurisprudence on the distinction between what is limitation on benefit, what is abuse of a treaty, and what is beneficial ownership. Fujitsu was one, Bid Services, another excellent ruling, Alibaba, another ruling. I think in terms of courts are getting it right. What would be very helpful is if there was guidance, official guidance for taxpayers with a little more objective criteria, then that would give a lot of clarity and certainty. And so, just on beneficial ownership, I'll just quickly skim through this. Like I already said, it only covers income transiting. The test that is relevant is the right to dispose income. The ownership of asset is not relevant. Ownership of asset is a different concept from ownership of the income. The tax status, whether the tax is exempt in the hands of the recipient, is again not relevant for determining whether you are the beneficial owner. The underlying formation of the entity cannot be questioned under beneficial ownership. I may have set it up, but you cannot question it under the income. You have to go under PPT or GAR or maybe a specific clause at some. Another important thing at beneficial ownership is not a term that is, it is very important that, and so I think in the Act also, Section 139 has a definition of ownership, but it's only for the purposes of the section. And it's very important from a public international law standpoint that the definition, both treaty partners have to have a common understanding of what constitutes beneficial ownership. Otherwise, there is very significant possibility of a treaty override if somebody has to enter definition of beneficial ownership. The other relevant point here is that the relevant domestic law can be relevant for characterization of the income. However, it cannot be used for the definition of substantive terms. So when we go back to article, one thing to say that it is dividends as defined in Indian law, is it royalties, FTS as defined in the source country? To extend that to say that we will also look at it for the substantive definition of beneficial, that may not be in the spirit of the. Finally, the treaty language is beneficial owner, ultimate beneficiary. So that is something that should also kept in. LOB, again, the simplified, when India signed the MLI, India had actually opted for the PPT plus the simplified limitation on benefits clause. And then, because there were not many countries who opted for the SLOB, the simplified limitation on benefits, India has agreed to accept the PPT as an interim measure. However, there are some treaties of India which have simplified limitation on benefits clause. The SLOB is criticized, it says that it only tackles the most obvious forms of treaty abuse. It's a bare minimum standard. But however, if it is there, it should be construed as the parties' evidence and the understanding based on which the treaty was entered into, and it should be respected. And so, like even Bijal said it earlier, if there is a specific clause that governs it, then to disregard that and go into a general PPT may not be the most conducive approach. LOB tests, again, the standard test, OECD guidance lays out the publicly traded corporation test, ownership test, base erosion test, active benefits test, derivative benefits and base erosions. and the residual rule. Now, the base erosion test, I think, is very interesting. Again, an area where guidance will be very helpful. Just for everyone's benefit, the base erosion test, it goes back to India's treaty with the US, and one of the limitation on benefits clause in the India-US treaty says that if more than 50% of the income is used to give to pay out non-residents in the form of whatever it could be royalties, it could just be like advertising expenses, formation expenses, so on and so forth, you will not be entitled to that benefit. Most recently, we have seen it in the India-Chile treaty. This is not something that is tested very commonly, but it will be very useful if there was guidance around how this needs to be computed. Otherwise, this could potentially become one very big source of litigation. Um, and so, really, just to conclude, a delicate balance is really needed when you're doing this. One is, yes, we do not want treaty abuse, we do not want tax avoidance, but at the same time, safeguarding of legal certainty is very important, and due weightage should be given to both. The more guidance there is, the more um, clarity taxpayers have, the better it is for everyone. And just while we are concluding, India is on a great growth trajectory. We are at 3.8 billion, hoping to touch 5 billion very shortly. The ambition is to become a 30 trillion economy by 2047. And so we should not lose sight of the wisdom of the Supreme Court when they said that treaty shopping may be a necessary evil tolerated in a developing economy in the interest of long-term development.
Thank you, Seema. I just have a very shortcut question to you, but I believe it's a difficult one. So if coming back to the concept of beneficial ownership, is the beneficial ownership clause the access for the treaty benefits, or it's really a specific anti-abuse regulation?
The answer is simple. It is controversial. There is, if you look
That's
at
a good way to.
Yeah, no, I mean, if you look at global jurisprudence, it's really, courts have approached it in both ways. Some courts have looked at it as a treaty entitlement measure. Some courts have as an anti-abuse. It's controversial. It keeps us in business.
Thank you very much. Thank you very much. Dhruv, the floor is yours, I believe.
Thank you very much. So the brief that I had received for my presentation was twofold. One was to cover the MFN judgment, which I've spoken about and written about, and the other was, is the debate surrounding static interpretation versus ambulatory interpretation of tax treaties over? Obviously, if the question is being asked, it's not over. But I thought, how do I best answer these questions was not to necessarily answer them directly, but do it through the prism of three Indian case laws. Of course, the MFN, I had to refer to the Supreme Court in Nestle. But I thought some of the issues surrounding...
Sorry, Dhruv, I just need to interrupt very quickly. Seema, unfortunately, has a prior engagement and has to take a leave right now. So I'm sorry to interrupt, just to let you go off. And then, Dhruv, you can continue uninterrupted.
Thank you. Thank you. So I thought let's perhaps look at some of the issues that arise from the three cases that I've mentioned over here, and look at it with a microscope, because the devil always lies in the detail. These three cases have raised several issues and have actually there are certain observations made which are often used as precedents. But I wonder if they really are precedents or if they are obiter dicta. So I'll take a closer look into that and perhaps raise more questions than answer them in the course of this presentation. So paragraph 100 of engineering analysis, by the way, I think most of these decisions, they come to the correct conclusion, but the manner in which they perhaps come to the correct conclusion might be suspect. I don't think Nestle is fully the correct conclusion as well, but we'll come to that later. Let's read this language a little more closely. Also, any ruling on the more expansive language contained in the explanation to Section 916 of the Income Tax Act would have to be ignored if the wider or less, or if it is wider or less beneficial to the assessee than the definition contained in the tax treaty, as per Section 90, subsection 2 of the Income Tax Act, read with explanation 4 thereof, and Article 3, paragraph 2 of the tax treaty. Now, this what is essentially says, if the same term has been defined in the Income Tax Act and the same term has been defined in the tax treaty, then because Section 90, subsection 2 says whatever is more beneficial applies to you, the domestic definition stands overridden by the tax treaty. I think there appears to be a fundamental issue with this. Let's look into that. Also, there's a reference to Article 3.2, which really bamboozled me, because 3.2 refers only to undefined terms, whereas over here the court is dealing with defined terms. So I don't think 3.2 has any relevance whatsoever. So let's perhaps ignore that for a moment. The fundamental issue is you could have exactly the same term. Let's think about residence. Let's think about permanent establishment, which could be used both in domestic law as well as in the tax treaty. But these terms, for each purpose, could have a completely different meaning, and they can coexist. Tax treaties and domestic law interact before application in very limited circumstances. They can coexist. First, you apply the Income Tax Act, figure out what the tax liability is, and then look at the treaty entirely separately, which operates on a different plane, to see how far it restricts domestic law. So to that extent, I actually think this paragraph is an obiter dictum. It was not necessary for coming to the conclusion that the court arrived at. And you could indeed have very, very different readings of the same term for different purposes. If one looks at every single definition in a tax treaty, it proceeds with 5 words, which I mentioned also yesterday, for the purposes of this convention. So even if you were to take a dualist approach and say, now that we have incorporated the tax treaty into the sphere of domestic law, the purpose of that definition is only for that limited purpose also in domestic law. It is only for the treaty provisions, not for the purposes of the Income Tax Act. Seema mentioned something interesting now that she's not here, but anyway, that you have definitions which can indeed, you can have reference to domestic law, also for figuring out definitions for the purposes of characterization of income. If one looks at the definitions of income, wherever they've been given, Article 10.3, for example, it uses the term dividends as used in this article. It does not even apply for the entire treaty. So what is dividend under domestic law could be different from what is dividends for the purposes of tax treaties. So I don't think domestic characterization of income necessarily has an impact on what is the treaty characterization of income. They can operate in different planes. That was issue number 1 that engineering analysis raised. And then you have, it's one of my favorite issues, grouses with engineering analysis, is paragraph 159. It states over here, persons who pay TDS and or assessees in nations governed by a tax treaty have a right to know exactly where they stand in respect of treaty provision that govern. Such persons or assessees can thus place reliance on the OECD commentary for provisions of the OECD Model Tax Convention that are similar to the OECD Model Tax. In the absence, now this is an interesting qualification here. It says, in the absence of judgments of municipal courts clarifying the same, or in the event of a municipal decision. I think there's an inherent tension in the 2 statements in this paragraph in itself. I've heard also at the Supreme Court, whilst I was there, one of the revenue officers conceding, well, it's covered by the OECD commentary, and this paragraph makes the OECD commentary binding on the tax authority. If the tax authorities do not disagree with a provision of the commentary, how exactly are we going to get to conflicting municipal decisions? So I would say maybe it's wise to read the entirety of this statement rather than saying it means that because you can rely on it means it's binding. I don't think it states very clearly that the OECD commentary is binding, but it does seem to suggest that the OECD commentary is very important in the interpretation. And I agree with that. What is the status of the OECD commentary in the interpretation of tax treaty? So one, of course, it's not binding. How far is it persuasive? One thing that the Supreme Court does not refer to is which version of the tax treaty. You could have a tax treaty concluded in the 1980s. Does the 2017 version of the commentary or 1992 version of the commentary? There have been so many versions of the commentary that have been around. Which version applies to it? And this ties in very well to the question of, do you refer to the commentary as a static means of interpretation or an ambulatory reference to a means of interpretation? Now, Canada and the Netherlands have very, very steadfastly stated that the reference should be static. And I thought this was perhaps a very good opportunity that the Supreme Court had to determine whether the interpretation should be static or ambulatory, but there clearly is no guidance in that respect. So there's a lot still to be unraveled in this controversy with respect to how far you can rely on the commentary. There's more to it. What happens when the OECD commentary contradicts itself? There are at least two instances, actually there are quite a few more in my thesis. If one looks at the commentary on Article 1, paragraph 6.5, we're referring to the 2014 model, and if you look at the commentary at paragraph 8 on Article, I think it's a typo, it should be paragraph 9 if my memory, read both. The reference to beneficial owner, the corollary that one has in paragraph 6.5 is that there could be two beneficial owners of the same income, whereas paragraph 9 on the commentary on dividends and the similar commentaries for Articles 11 and 12 state there can only be one beneficial owner. You must discover the one person to whom the income is being paid to. That's what beneficial owner clarifies. Which one is true? On Article 8, place of effective management. The old Article 8, which has now been amended in the model, but in all of Indian tax treaties, it's still the old article. Profits of an enterprise operating ships and aircraft in international traffic shall be taxable only in the state, not even contracting, the state in which the place of effective management of the enterprise is carried on. Is this enterprise referring to enterprise of a contracting state, which in turn is defined as enterprise carried on by a resident of enterprise meaning the entity? Or are they referring to enterprise as defined as in Article 3.1h, the carrying on of a business? Well, the commentary from 1963 up to 1998 said the term enterprise refers to the carrying on or the operation of ships and aircraft. That is the carrying on of a business. This commentary was turned around on its head in 1998 to say, no, it's referring to the entity. This issue was identified already in 1963. And thereafter, in 1998, they had a change of heart. Which commentary should we now rely on, where the OECD on the same issue has changed its view? Let me exemplify the earlier version of what we were talking about. So you've got state S. ESCO is a resident of state S, which pays dividends to HCO, which is a resident of state H. Both these states treat HCO, which is a company, as an opaque entity. No problem. We know that the HS tax treaty will apply, and the dividend withholding tax under this treaty is 10%. But you now have RCO, which is a resident of state R, and state R views HCO as a transparent entity. If one relied on, and therefore it attributed these dividends not to HCO, but directly to state R, that is RCO, which is a resident of state R. If one looked at the commentary at paragraph 6.5 of the OECD model, it stated, well, in this case, both tax treaties will apply because the source state must follow the attribution rules of the resident state. And so in this situation, state S's tax liability is restricted to 5%. would that quite be in consonance with the concept of beneficial owner as to whose disposal the dividends have been put at? Clearly not. There is conflict between two parts of the OECD commentary on the same issue. So I think it would be rather unwise to say that the OECD commentary now present the absolute ordinary meaning of terms used in in a given tax treaty. So where exactly, what is the status of the OECD commentaries? Well, Klaus Vogel, in a very, very seminal article written in the year 2000 in the Bulletin of of International Taxation, published by the IBA, gives a very clear idea. And this is, it's not seminal per se, but it's a very important article, and I recommend everyone read it, because Klaus Vogel was traditionally, for a number of decades, a proponent. The OECD commentaries give you the ordinary meaning in the sense of the international tax language as used in of tax treaty terms under Article 31 of the Vienna Convention. And he defended this position again and again and again when others disagreed with him. And he had a change of heart. And he said, well, the number of changes that are being made to the OECD commentaries are so radical sometimes that they have actually lowered their own esteem. And so he says, if you have OECD commentaries on terms which were used in the 1963 draft, and then the 1963 commentary provides to you the ordinary meaning of the terms. Again, if you had 1977, because, for example, the concept of beneficial ownership was introduced in 1977, not in 1973, then the commentary of the contemporaneous commentary of 19 provides the ordinary meaning. But any later commentaries thereafter, without contemporaneous changes in the model itself, one could wonder if it has a special meaning, or potentially it could be a supplementary means of interpretation, which could only be referred to in a situation of ambiguity in the interpretation of the by looking at the text of the treaty and ignore the commentary entirely. And I say he wasn't entirely sure where it stood, if it provided a special meaning or if it provided a supplementary means of interpretation, which is downgrading it quite greatly. And he concluded this article by saying, and I quote him, as the opinions of experts, like we have Michael Leonard, we have a lot of scholars in this room also, who are these experts that Vogel was referring to, the commentaries take their authority, at least in part, from the force of their arguments. And with respect to those arguments, the commentaries have to compete with the opinions of similarly high-ranking. So an article in a journal, a thesis, I think, according to Vogel, was at the same level as later OECD. And so these are issues I think one must very much be alive to whilst looking at the OECD commentary. Oh, I have 1 minute. Yes, of course. So I think I've spoken about the MFN case quite a lot. And I think the idea of subsequent practice was not in good faith. I will just very quickly look at a very hot potato issue, which is currently live before the Supreme Court. And I've filed an amicus brief before the Supreme Court as well on this. The term royalties, again, as used in the Article 12.4 of various Indian tax, refer to payment for a secret use of, or the right to use of, a secret formula process. Now, the Indian Act has been amended in 2012 to say that this expression means secret formula or secret process. The question before the court has been whether the adjective secret applies or qualifies both formula or process. And there was a Delhi High Court decision, which was more than 50 pages, which belabored over this point. I don't think that is necessary. Of course, secret formula or process is a term, and it is undefined. Could you rely on Article 3.2 to take the domestic definition? I think here is an instance where the context requires otherwise. And how do I determine whether the context requires otherwise? Look at Article 33 of the Vienna Convention and look at the 1989 India-Netherlands tax, which was concluded in Hindi, Dutch, and in English. But I will not, there is no divergence, so to say. They're equally authentic and equally applicable. I will not get into the Hindi version. They don't help us. but due to a certain quirk of the Dutch language, it uses the term een geheim recept of een geheime werkwijze, a secret formula or a secret process. And the term secret qualifies both. Is there a divergence? No. We have an internal context given by another language which solves the problem quite straightforward. And I think the revenues case is quite clearly destroyed by the language over here. And the same can be also figured out by the reference in plural of secret in the French version of the OECD. And also, if you look at all Indian tax treaties which have been German, Dutch, or French, the same outcome follows. So I would say, well, it is Indian practice where the treaties context says indeed it's secret formula or secret process. Thank you very much.
Thank you for your comprehensive presentation. Michael, please.
Quick question. There is an OECD, the OECD deployed. To see that as whether they're relevant.
First of all, it's a phenomenal question indeed, because it really raises the issue of does a club of 38 rich countries now dictate the terms also for members who are not or members of the UN who are not members of the OECD. I think it is a nuanced answer over here, because if you look at it, there are very few issues that the OECD gives a very clear interpretation. It usually says, oh, some countries believe this, other countries believe that. Countries who believe the minority view should clarify in their bilateral. The UN, insofar as it adopts the OECD language, the UN model, it also adopts the commentary. And if you look at the UN commentary, large sections of it are just reproduction of what. And I agree with Vogel that perhaps the UN commentary, of course, is different because they're just reflections of personal views of the members of the committee rather than the official country views. So I think perhaps, and because the OECD has traditionally been evolving the model and treaties with that, I think the OECD perhaps has a greater influence than the UN model does. But I don't think that is saying too much in any case. But I think both of them should indeed derive their validity from the force of the argument that they're making for the purpose of saying this is the correct. There are so many articles that have been written, professors, by scholars in this room as well, that disagree with certain positions of the OECD commentary. And I think you should really look at logic and the force of argumenting rather than saying because it's the OECD that it is the correct, irrespective of whether you're an OECD.
I agree with that, and probably we do too. It's not a new interpretation of what was always the case. So it's not really ambulate whether that's valid or.
Thank you very much. Very good. I think special thanks goes to panelists for their terrific days. I leave the floor to Rachel to conclude our presentation.
Thank you all for your time. Obviously, as you can see with tax treaties, there are still a lot of issues, I think, need to be resolved, really with definitions, how they work, what you think is technical, what I think is technical, what the tax authorities think is technical is very different and vast with beneficial ownership. I take away from Bijals as well. I had this vision of you going to clients and say, okay, with this structure, you're not going to get questioned, but this is how much you have to pay. With this one, you might get questioned, but we can argue. And this one you'll definitely get, So I have that vision in my head. And Dhruv, really, this question, ambulatory, static, it's been around for years. And I think it's something that we will continue to debate upon. Of course, lots of gray here, but this is tax. Tax is gray. If it wasn't gray, we wouldn't be doing tax, we'd be doing auditing if it was just pure black and white. So I thank you all for your time. I don't want to eat any more into the time allocated to us. And please give a big round of applause to my panelists here with us today.
Thank you very much, all the speakers, all the panelists, for that rather interesting, informative talk. I would like to call on Mr. Bhutani to invite our speaker for the luncheon address. Thank you.
Thank you, Jackie. It's a privilege and honor for me to invite Dr. Akim Pros. I'm not going to read his resume. We all know that he's a deputy director at the OECD Center. Last night, Dr. Pros, when I asked him, is this your first visit to India? He reminded me that his association with India dates back to the IFA Congress of 1997. And he also shared with me that he was the recipient of the most prestigious International Tax Award, which is the Michelle Carroll Award for his thesis. Extremely delighted. I also wasn't surprised when I asked him about his background, and he told me that he worked for one of the leading law firms. Incidentally, I happen to be working with many of his former partners at Covington, which is one of the leading law firms in Washington, D.C. In his resume, he said he worked in the tax department of a US law firm with offices in DC, Paris, and London. He was previously assistant Munich University's research team. Over to you with that, Akim. I also wanted to mention one more thing, and I think my friend Michael Lenhart described it, that he has the sharpness of an academician, but an agility of any tax practitioner. Over to you. Thank you.